Well, I'm glad that everything's not as empty as my Valentine's date plans, but it's like we will begin currently then. So how's y'all's day been going? Pretty good? Pretty good classes, getting homework, tests. I think I have a midterm coming up Wednesday. I have a midterm coming up. Hopefully not. Make sure to check your syllabus, guys. We'll go ahead and sign in, scan the QR code, and then we'll move on shortly. Kind of like a little thumbs up or raise your hand if you still haven't scanned it and you can scan it. Almost. All right, today's general meeting agenda. We'll go over outperforming moments, a little quote, and Nathan's going to be speaking on macro investing and fixed income. Then we'll move over to the sweet spot, and of course, doing little society updates and signing in on some stuff we have next week. Any outperforming moments that we have from the audience? Small, big. Anybody? Yes. Job offer. Where from? The government. That sounds scary. Awesome. Any other outperforming moment that we have around them? Even the little things count. Nice, awesome. Congrats. What job? Nursing, awesome. Congrats. One more. The other trifecta, one more. Going once.
100 on my stats exam.
100 on stats exam. Whoa. Awesome. All right. Well, any last stragglers? No? All right. Well, we have the quote of the day from Warren Buffett. The most important thing in terms of your circle of competence is not how large the area of it is, but how well you've defined the perimeter. So just, write me a quick page analysis on it and submit it by the end of the day. Hopefully this quote speaks to you and the ones that we have upcoming for further weeks. And now we will move over to Nathan with macro investing and fixed income.
Okay, so this week our presentation is a little bit more, I guess you could say, complicated or in depth than last week. And I do have to move a little bit faster than usual, so I'm gonna try to keep it at a solid pace. Let's go ahead and get started. So looking at what we have today, macro investing, currency markets, commodities, fixed income markets, a little fact about the Bank of England, one current event, and then some feedback as well. So really quick, just to start off tonight, how many nines are between 0 and 100? Can anyone tell me? No, not 7. You're close. No, it's not 11. It's not, it's close, not 19. It's not over 20. It's not 17. We're not moving on till we get it.
19.
It's not 19, it's really close to it. You're going the wrong way. It is 20. So 99 counts twice. So that's why there's 29. Okay, so first thing, macro investing. So when you think macro, micro, you think big and small, right? That's a good generalization of the two. Macro is obviously the big environment, not necessarily within any company's control, not only within a country's control, just large scale. So for example, GDP, inflation, rate, politics, population. And then micro, so it's really small countries, companies that control these things, and that's also very short term. So macro investing is very long term. It's not really get rich quick kind of thing. It is a very weighted out kind of investing strategy. This is just defining macro investing. So it's really analyzing broader market trends. So when we talk about things in the future like Forex or commodities, these are things that all countries trade. It's something that if you're looking to invest in these things, you might want to have a little bit more experience just because they can be a little bit more volatile at times. As we said last time, it's not gambling. You need to have a well-researched opinion on these things simply because it is pretty complicated. And if you take Professor Sweet's class, he'll tell you that too. So this is just a quick review of some different asset classes. So when I said Forex, that just means foreign exchange currency. So it's like when the US dollar is traded for yen and when the Canadian dollar is traded for the peso, like any currency traded for each other. It's also known as the most liquid market in the world. So it's a very popular thing. It's just not something very common for people like us to put our money into. The fixed income or bonds we talked a lot about last time, and we'll do a little bit deeper dive today. Derivatives, which are just investments derived from an underlying asset. So if you invest in one thing, that means something, an external factor is affecting that underlying investment. Commodities, things like gold, oil, and natural gas, even stuff like grain and wheat, those are all kind of commodities. Equity index is simply measured that are performance of a group of stocks within a particular financial market, and then obviously the rate changes for each of these kind of markets. So moving on to currency markets. So these, just like stocks, just like any other thing in the world, are affected by supply and demand. Each currency has something that's overvalued, some are undervalued, but everybody wants currency, right? You want a lot of money, I want a lot of money, countries want a lot of money, banks want other countries' money. Some countries want other banks' money because their currency is more valuable than their own currency, so their home money. Simple, quick formula or way to think about it. If a country is exporting more than it's importing, that means their country is appreciating. They're sending a lot more things out. Countries are buying their products, so their currency will appreciate. If a country is importing more than it's exporting, the currency depreciates. That means they keep having to pay for stuff to come into their country, meaning they're spending more money, meaning it depreciates. Just a quick term to note is relative valuation. So it's just a model used to assess the value of one currency to another. When a business or company is being evaluated, that's a term you're going to hear, valuation. How well is the company doing against other companies? It's the same for currency. Two really quick terms are risk on and risk off. So risk on is when investors want to take on a little bit more risk, they'll invest in currencies such as the Australian dollar, the euro, and the British pound. Those are just some examples. Risk off are typically considered safer currencies like the US dollar, Japanese yen, and Swiss franc. Only because risk on currencies are usually linked to more volatile things like commodities, like oil, like gold. Whereas risk off currencies are pretty established, they're pretty set in their place, and you'll see that in the next slide as well. So this is just a quick thing on floating currencies. The base is always going to be on the left side, and the counter or the quote is going to be on the right side. So just a little bit deeper dive into Forex. If you get into higher level classes, we'll start to see this. And just like a stock, you can go long or you can short the currency, and we'll get to that at the end. But just going long means you're going to hold on to it. You want it to appreciate. You want it to gain in that value. And shorting it, you're betting against it. You think it's going to depreciate. You think the market's going to go against that currency. As you can see on the top left of your screen, those are the major currency pairs. So the top four are the most commonly traded pairs in the entire world. The last three are the most common traded commodity currencies. As you can see, the US is involved in some way on pretty much all of them. And as you can see in the chart, the US is involved in about 50% of all currencies globally. So you see how strong the dollar really is. But that doesn't mean that the dollar is the strongest currency. So the Swiss franc and the Japanese yen are actually a little bit more stable than the dollar just because of political, economic events like that. So just because the dollar is used in a bunch of trades, it doesn't mean it's the most stable or strongest currency. Now we have commodities. So pros and cons of commodity trading, like I said, it can be very volatile if you don't know what you're doing. But it does offer some diversification. So as we talked about last time, your investment strategy, your portfolio should be centered around diversifying your investments. So you want to have some stocks, you want to have some bonds, you could short some stuff, you could hedge some bets, and commodities are just another way of doing that. They're very liquid, so there's a pretty low entry point, and you can exit or enter positions pretty easily. And like I said, with inflation hedging, commodities do offer some sort of protection against certain political or economic events. Because everybody needs commodities, everybody needs wheat, the gold is backing the dollar, natural gas is used a lot, everybody needs oil for their cars, so commodities are relatively well used, but also volatile. They do have a little bit of a lack of income. You're not going to get the same amount of return as you would as if you were investing in, let's say, Google or Microsoft, those kinds of stocks. Commodities are a lot more small scale. And then there are a lot of legal stuff surrounding them. So you can't control any of that. You just have to read the market well. You have to kind of hope and do your own evaluation like we talked about before. This is just a quick chart of gold commodity from 1973 all the way to 2024. If you see some spikes, that's usually due to political or economic instability or stability. Within the US, it has to do a lot with inflation and the Fed raising interest rates. So if you see that spike around 1981, that's only because the Fed had to raise interest rates to combat inflation in the 70s. And then this is another commodity, so cattle. So almost everything that isn't something major traded like a stock bond, the small things, everyday things, those are what the commodities made up of. So you can see cattle here, it can be broken into all cattle and then broken down into different layers. So everything you can think of has a part like this, where it's really broad, and then you can kind of narrow it down to individually specific items. Okay, this is going to take a large part of the presentation. So fixed income markets. So just a quick overview of what a fixed income market actually is, referencing what we talked about in Investing 101. So you want to remember an inverse relationship. Bond prices and yields have an inverse relationship, meaning that when bond yields rise, prices fall. When prices rise, yields fall. And we'll see an example of that on the next slide. You'll see all the different kinds of graphs that a yield curve can actually have. So what actually affects the market, right? We have fixed income markets can be volatile depending on several factors, a lot of them being economic data, geopolitical events, central bank policy changes. So if a country is going through a really rough economic patch, their government can institute some laws that are favorable towards certain bonds, unfavorable to certain bonds, short-term, long-term. A lot of it does have to do with the government and what the government feels is right at the time. And the government doesn't always agree with you. So if you think that you're right and the government's wrong, that's one thing you can't really control. And then two general topics you gotta know about is country cash flow and country risk. So country cash flow is simply the net amount of cash and cash equivalents coming in and out of the country. A fixed income market is really an indicator of that, simply because it shows how much faith investors have in a certain country. Just like the US, and you'll see on the next slide, we have an inverted yield curve. So investors are really, really confident about the short-term investments in the United States, but they're not so confident about the long-term items, like a 5-year, 10-year bond. And then we have country risk. So what is going on in a country? Countries like Argentina, Venezuela, usually the US is used as sort of a measuring tool. And so investors typically compare other countries to the US just because the US has a strong government bond. So the US has never not been able to pay out a bond. That's why it's used as the main factor when measuring against other countries. So Argentina just had a new election. So that creates a lot of political instability for people against him, a lot of favorability for people for him if they're trying to read the market. So what's the point of all this? Why are treasuries matter in this place? Well, first, they're pretty much just worth of guaranteed return. So they do have a high return, usually in the long term. However, as you can see with that chart, that's not the case today. As I said, we have an inverted yield, simply meaning the short-term investments are worth way more and have a higher yield than the long-term investments. As you can see from a year ago today on the bottom line, February 2022, it was a normal yield curve. We had short-term investments having lower yields than the long-term investments, but now it's flipped. Risk profile. So as you can see on the other side of the screen, how much risk are you willing to take on? Some people are super aggressive when it comes to investing. Other people are relatively safe. When it comes to risk tolerance, if you want to invest foreign, a lot of that is taking on a bit more risk because you have to know more about that country, more about their currency. But if you want to be relatively safe, you can stay on the US side of it. But as you can see, nothing's guaranteed. With the inverted yield curve, that can also mean an economic downturn. So a really interesting or kind of scary fact is that an inverted yield curve has predicted 10 out of 10 recessions since 1955. So it's not guaranteed, but it does mean that we're heading towards sort of an economic downturn. And then how to interpret the treasury yield. So if you see, I know it's hard to see, but the blue is a normal yield curve. So that simply means investors expect the economy to grow at a regular, steady pace. But if in the short term, it usually has lower rates than the long term, which obviously isn't the case today. A flat one simply means that we could be heading toward an inverted yield curve. It means the economy is kind of questionable. Investors are a little bit more speculative than usual. And as I said, it leads to an inverted yield curve. So inverted means that long-term rates are shorter than short-term rates, or lower than short-term rates. It means that the market sentiment, the central bank may have raised interest rates, which means tighter lending, slowing down the economy. The economy is just not doing what it should be as a whole, or what investors expect it to be doing. And then we have a steep yield curve, which is super rare and doesn't really happen too often, but it just means that 30-year rates mathematically have a higher percentage point than a 3-month treasury. So that means the economy is overperforming, doing really, really well, but it is kind of rare, and obviously we're on the other side of that right now. So bonds, a lot of bond stuff is not interesting to some people, but it's important to know these things because it does help you diversify. It does help you in the long term. It does help you in a future career. So we have simple definitions. So face value or par value. That just means the amount that the issuer promises to pay once the bond reaches maturity. And we'll do an example of this on the next slide. So then we have what's called a coupon. A coupon is the annual interest paid on the bond, and it's usually expressed as a percentage. It just means that that's how much you're going to be paid every period until the bond is finished and matures. Then what is maturity? So yield to maturity is the total amount of anticipated return on a bond until it matures. So a bond can be held for a month, 2 months, 3 months, all the way up to 30 years. And that's what yield to maturity is, the numerical value of how much you're going to get back on your investment. A premium, so bonds are typically sold at $100 or $1,000. A premium means a bond is selling for higher than one of those amounts, meaning you're paying more to get that bond, to get the interest on it. Whereas the discount at the end there simply means that the bond is undervalued. So let's say you buy a bond for $80 or $50. You're still getting the same amount of return, you're just buying it at a much lower price, at a discount. And then principal is simply the original amount of money invested. And then this is just a quick graph of the 10-year treasury. As you can see, it's what they call that today, 4.27%. So yields are 4.267%, but as you saw in the last graph, the short-term bonds, like 1 month, 2 month, 3 month, are a lot higher than what this rate is right now. So we've already done a quick quiz of this. These are just some simple definitions. You might win something afterwards. So zero coupon bond is a debt security instrument that does not pay interest. So these bonds simply trade at a steep discount. So you don't get any coupons. You don't get these periodical payments. You just put money in and you get money out at the end of investment. And then we have coupon bonds. So coupon bonds are kind of declining in popularity, but it's just a debt obligation with coupons attached that represent semi-annual interest payments. So really quick, we have, that's the formula that y'all are going to be using in 3 seconds. So price is equal to the maturity value divided by 1 plus R. So R is the required rate of interest and N is the number of years until maturity. So if we have a 1-year zero coupon bond that pays out a principal of $100, if it has a discount rate of 5%, what should that bond be worth today? I'll give you all a few minutes, seconds, however long it takes. But the first person to have the answer, raise your hand and you will get a prize for it. So go ahead and figure it out on your own. Anyone else? We're gonna try to quickly. Next person up. Really simple equation, really simple calculation.
Even if you think it's the answer, just start out. You never know.
What you said? Close. Yes. So yeah, 95.24. Come down after the meeting. We'll give you a little prize. We'll email it to you. But yeah, 95 points. Does everyone see how much you got that though? Does everyone understand? Just plug it into the equation. So you put the 100 into the M, you divide it by 1 plus 0.05, and that's how you get 95.24. Good job. So now we're going to talk a little bit about interest rates. So what goes into them, what affects them? So we have different kinds of interest rates. So we have nominal interest rate, we have real interest rate. We're going to talk about nominal. Nominal is calculated using the real interest rate and inflation expectation. What that means is that the interest rate is not adjusted for inflation, so you have to calculate the nominal interest rate. The real interest rate is adjusted for inflation using the expected inflation rate. So it's a little bit confusing, but that's the formula right there. So the nominal is equal to 1 plus real times 1 plus pi minus 1. Really simple equation. You definitely will see it in classes like money and banking and higher up finance courses. Then we have the central bank converting into monetary policy. So the central banks make the legislation, according to the Fed. So they regulate and support the banking system or monetary system via manipulating the money supply. So the money supply, an example right there, the Federal Reserve, European Central Bank, and the Bank of Japan. Those central banks control the flow of money for the entire country, for those governments. Credit default risk, like we talked about last time, we're investing in high risk, high reward. This is something similar. So credit default risk, the likelihood that a borrower will not fulfill payment obligations. So let's say you took out a loan, what's the chances that you pay that loan back? That's what a bank has to weigh of credit default risk. Influences interest rates or yield on loan and bonds. So if you have a higher chance of not paying it back, you're going to have a higher interest rate. So you're going to have higher credit risks. That means the bank is going to want to charge you a higher interest rate on the loan that you take out. Higher risk means higher returns as a result of uncertainty. So if you invest in, let's say, not so good bond, which would be something like South Africa, with a rate a little bit lower than other countries, that means your return would be higher, but your risk would also be higher. Now, the bond has a higher risk of defaulting, the bond has a higher risk of just not going through. And then we have demand, risk, and premium. So risk premium is an additional return demanded for taking on increased risk of default compared to risk-free assets. As it says, it's an inverse relationship with yield and rates. So the supply and demand effect of prices. So all these things go into what affects interest rate for a country, for bonds. So when the Fed is calculating rates, yields, all these kinds of things, this is what goes into it. This is how your investments are determined. If you don't know these things, then you're just kind of gambling. You don't know what goes into the money that you're investing. You don't know what goes into the money that you're spending. So these are all the things to keep in mind. Then we have the Bank of England. So this is a very interesting one. It relates back to our original topic of Forex, of foreign exchange currency. Does everyone know who George Soros is? Does anyone have heard of him before? Yeah. Okay, cool. No matter what you think of him, he has made a lot of money. So the whole story about this is called Black Wednesday. So it goes back to the pound versus the mark. So the mark is German currency. The pound is obviously what we know today as English currency. When this all started, the British government tried putting the pound to equate to the mark. That means they wanted the pound to equal the value of the mark. The problem is the German currency was way stronger than the British currency. So that really wasn't going to work no matter how they tried it. It didn't get off to a great start. The Bank of England had to really increase interest rates to try to keep up with the German economy. However, this led to really, really quick high inflation in the UK. Soros did, and other speculators, what's called shorting the pound. So as we talked about earlier, you can short currency just like you can short a stock or any other kind of investment strategy. Shorting currency simply means you bet against it. So Soros took out lots of money. I believe it's estimated he took out about $10 million or $10 billion in a position against the pound. So obviously he had a lot of money to work with. We can't exactly do that, but you can still short your currency with whatever money we have. Soros, like I said, shorted the pound because with his research, he realized that the Bank of England could not keep up with this currency. They couldn't keep overvaluing the pound. They couldn't keep overvaluing and equating it to the mark, or what's called the European exchange rate mechanism. So Europe has a whole mechanism of currencies, how to equate a different currency to another. That's what led to the introduction of the euro, trying to make it a unified currency. But Britain, I don't know if y'all like the British, but they always want to do their own thing. So Soros borrowed a lot of money against the Bank of England to establish that position. Then the bank pretty much collapsed. The country could not keep up with those interest rates. The British government realized they couldn't keep up with people betting against their own government. Their own citizens were betting against them. The whole world was betting against them because everyone realized they can't do it. There was no human way possible that the UK could keep up with other currencies and other investors trying to short the pound. So he used what he has called a quantum fund, which is his hedge fund, to borrow billions of pounds from various banks around the world. So he didn't only borrow from the British bank. He took out money from there's a multitude of countries that he took out money from. And he borrowed against the pound. This led to him making almost $1 billion. So the currency really collapsed. So you can see it has up and down. But when on Black Wednesday, when the UK finally admitted we can't do this, we don't know what we're doing, there's no way to keep this sustainable, it crashed. And it crashed bad. It hurt the UK citizens, it hurt the UK economy. But some can argue that it made pretty good long-term investment because as you can see at the beginning, they're starting to trickle back up, and today they're doing fine or a lot better. But that's just one example of how to short currency. It's looking at the market, looking at what's going around, what's going on around the market, seeing what actually happens. And then current. So this was a pretty quick presentation. I know about time today, trying to get y'all the background, develop plans. I don't. So we have one current event today. I don't know if you saw this on the news, but Lyft had a really interesting day today. So they did hit a 52-week high following Q4 reports, but they had a typo in their earnings. So somebody messed up somewhere where thousands of people are reading these documents, everyone's reviewing it, they messed up. They stated that their company was expected to grow by 500 basis points, which is 5%. That's a lot for a company like Lyft. But it was only supposed to grow by 50 basis points, or like 0.5%. So the whole market reacted like, whoa, Lyft is doing really well for the Q4. That's what that huge spike is on today. It was really unexpected. The CEO and CFO, I came out and they were like, we don't know how this happened, my bad. So that honestly could lead to some legal investigation because there's so many people looking at this. How do you mess up that 1-0? So that is pretty interesting. I don't have anything else to this. If you have any questions in the presentation, y'all can ask now. If not, I will hand it over to Professor P for the speaking part.
All right, so I got the people interested in Costa Rica. I'll be setting up information meetings. I think 20 people said they're interested. We can probably take 12, so we'll have to work that out. But that's good. It's a good problem to have. I was checking with the people down there. How many people can they actually house? And it kind of depends because they're doing this foster care is taking part of our bill, but we'll get it worked out. I think I can take 12, so look for that. If you sign up, I'll email a meeting probably on 2 different days, just in case your schedule doesn't fit, but we'll get that worked out. I want to talk to you. I mentioned this a little bit in the first meeting, this idea of a dashboard. So what I want to do, this is kind of my dream, but we haven't got it quite official yet. But what I'd love to do is have a small team of students in the Investment Society meet. I'm going to start doing this Monday at 3 o'clock. So we'll have to find 2 or 3 students. My idea is we sit, we have our dashboard meeting. We talk about markets. We're going to talk about here. I'd love to start a blog where we have a blog that says what finance majors should know walking into an interview. And these are the kind of things we're talking about. So you sound like you're up to date, like the Lyft discussion today, anything happening major. So this is the dashboard. So what do you want to do with the dashboard? What are the major trends? So I talked to my investment class today. Growth stocks are killing value stocks again after 2022. Large cap are killing small cap. Japan's coming back strong. China's struggling. Those are the trends. The second thing you're looking for is there a new trend forming? And when do you know it's forming? So you can't just in one day. So like me, small cap, I keep waiting for small cap. Boy, they had a big Monday. So okay, finally, big Monday. They had a horrible Tuesday. So okay, there it goes. So Monday they were happy. Tuesday, because of the CPI report, small cap sold off like 4%. They're up like 2% on Monday, down 4%. They're up a bunch again today, all over the place. Does that sound like a trend? A lot of noise. What happens at the beginning of a trend? A lot of noise, right? The trend's trying to figure out what's going to go on. So it's either going to be a trend and you do this, or a trend and it does that. So that's what you call volatility and convergence, where it's just going sideways, but in a really jagged way. So you want to watch that because you want to see it before everybody else does. And that's what the dashboard is saying. If you're going to look at things once a month or so, that's not enough. So does the current trend give you any information about what's going on in the economy? What's the trend telling you about the Fed, about the election, about the economy, about employment, those kind of things, CPI? Is there something, is it consistent? Or is there something bizarre going on that's not explanatory? Is there a good historical parallel today? So like to me, small cap value did horribly in 98, 99 and came roaring back in 2000. Growth did great in 98, 99 and sold off. Is that the same thing we're seeing today? Are there some big differences? Can we find a parallel that can help us with that? And then obviously going to an interview, there's certain key statistics you should know. So we know the S&P hit an all-time high here a few days ago. What was that? How far have they come off of that? You want to know those kind of things. Those are really important. Or if you're approaching an all-time high, how far away are you? What is the S&P level? It's really easy right now because we're right around 5,000, so that's easy to remember. So those are important. What was a recent low, recent high? Everybody knows what the 1.2 is. The daily. That's just daily standard deviation of the stock market. So that's a good benchmark. If the market moves more than 1.2, either positive or negative, you know it's a big day. So you can kind of work that. If you see the market up 1.7, you can say, wow, it's a big day. If it's up 0.2, you don't want to see it's up 0.2 and go to an interview and say, wow, did you see the market really rally today? Like, really rally, it's up 0.2%. Or if it's down 3% and you're like, yeah, it's down a little bit. No, it was down a bunch. 3% is a big day. Like small cap down 4% yesterday. That was a big day. 10-year treasury, where is it right now? So we've seen it, treasury selling off and back up above 4 significantly. What's the Fed funds rate? You know, the 5.25. How steep is the curve, or is it negative slope right now? You may know what the 6.5 is. One standard deviation on the 10-year treasury. So if you see the 10-year treasury move more than 6.5 basis points like it did yesterday, big day yesterday because of the CPI report, that's a big day. So if the 10-year treasury goes from 4 to 4.1%, how many basis points is that? 4 to 4.1. Is it 110 or 1? 10 basis points, is that a big day? 6.5 is 1, so 10 is a pretty big day. I think we saw 17. If you, what was it? Yesterday was 17. I can't remember. We hit 17. That's a huge day. 17 basis points up. Just like Nathan said, that's a big down day for bond prices. You want to know that going into an interview. What's the 80 basis points? Anybody remember that? No. So the 80 is what Nathan was talking about, the yield curve, whether it's steep or not. 80 is the normal, the 10-year versus the 2-year. So if the 10-year is at 4.8%, what would be the normal for the 2-year? Go the other direction. So the 2-year is usually lower. So if the 10-year is at 4.8, the normal 2-year would be 4%. Right now we're split. It's negative right now, but 4.8. So if you remove that 80 basis points, then you know whether. So if the 10-year is at 5% and the 2-year is at 3, what kind of yield curve would that be? 5% versus 3. That'd be a very steep yield curve. If the 10-year is at 5% and the 2-year is at 4.8, what would that be? Somewhat flat yield curve. If the 10-year is at 5 and the 2-year is at 5.6, that would be inverted. So the 80 lets you know whether you're normal or not. In an interview, well, you'd sound so intelligent. Say, man, yield curve is, you know, it's the norm is 80 bips and now we're at negative 80. So the yield curve is very inverted right now. The Fed, what's their probability of rate hike? Bloomberg gives you that. You can pull that screen up. That's something we'll look at in our dashboard. Key economic numbers like CPI yesterday was a bad number. They're expecting 2.9, got 3.1, but even worse is the core. The core is just terrible. So why is the core so terrible? The Bloomberg machine has a great chart for that. It's really, really interesting. You see energy prices down, and that's why headline inflation is lower than core. Core excludes energy, but why is core up so high? Those are numbers you want to know, and et cetera. Why et cetera? Because it depends on what's going on. Sometimes you don't care, sometimes you do. So the jobs report a couple Fridays ago was a big deal. You want to know about that. So it depends, but there are certain things you should always know walking to an interview that you want to check and make sure you're ready to talk about that. And you want to supersede the conversation. You don't want to walk in and they say, hey, what do you think about the treasury market? You want to walk in and say, hey, man, you see the treasury market today? That's the kind of interview you want to do. So you supersede, you've got the wild stuff ahead of them. Now, if you're interviewing with the accounting side or HR, they just think you're a genius. They're like, what's a treasury? Never heard of that. Basis points, what's a basis point? But you just sound like a genius. And what are they going to do? They're going to shake their hand like they know what you're talking about. And they're going to go back and say, man, I just talked to this genius. you're talking to a finance person, you better know what you're talking about because you're not gonna know them. But if you supersede it, they're not used to finance majors knowing about the market. Most finance majors are reading textbooks that were written 10 years ago. They're not used to you knowing the market. So you got to supersede that. So you go in with that, hey, well, you see the treasury market today, that was incredible, man. It really reacted negatively to that CPI report. You're already ahead of 99% of the people you're competing with. So, but how do you do that? You got to be doing this every week. You got to know that story. And if you do it every week, you talk about it. I'm not talking for an hour. I mean a 10-minute meeting. Say, okay, we see any trends straight? What is the trend? Same trend. And what I want the blog to do is to say, here's the trend. Here's what's going on. May not change week after week. Any new trends, any major news. I did that at USA. Every week I had to write an article every Friday. I drafted the first one, went around. Cliff rewrote half of it. I've been talking to Cliff this week. The two of us have retired, but it was fun. I mean, the two of us, we'd have these big debates. But what are we going to give out to the sales force? So we're saying, what is our view of what's going on in the market? We had to do it every Friday. We kind of got old after a while because this is the middle of 2008. So everything's bad. And the next week, everything's still bad. The next week, everything's still really bad. You kind of run out of things to do. But then when someone asks you a question, you've got it at the tip of your tongue. You know exactly what's going on because you're talking about it every week. Questions on that, you see what a dashboard does for you. So here's what's going on. Here's what I'm talking about. Large companies are doing strong. Small cap haven't been doing well. I look at the past week, year to date, and the past year. And the past week is where I'm looking for a trend change. That's where a couple of days ago, small cap been doing badly, but they had a great week. That's when I go, oh, okay, is that going to work? And then yesterday killed all of that. So that's what you're looking at. And you can look at the markets I look at. And then I'll look at sectors, which sectors are doing well. Obviously, tech and communication services are doing well because tech's doing well, Meta's doing well. What is that story? What's going on? Try to get that in my mind as well. And then I'll look at the world. US is doing great. Europe's doing terribly. Japan is doing great. That's an interesting trend. Why is Japan doing great? There's some stories there. Europe has just been a horrible. China has been doing horribly, but they had a good week this last week. Is that a trend change? Is this a reaction to just so much bad news or like it can't get any worse? So I'm not a fan of China right now just because of what President Xi is doing, but is it possible they went too far and it got really, really cheap or not? But you look at China down to 18%. When US is up 20%, that's a pretty good change. But then last week, China had a strong week, up 1.6. Japan, incredible week. Also, they're in currency. So Japan doesn't look as good as it is because you convert it to US dollars and it kills some of that. But so if anyone's interested in that, email me or call me or catch me if you want to be part of. We can't have 50 people, but if 2 or 3 of y'all want to be part of the dashboard meeting, we start writing blogs. I think that'd be incredible. I think we could have. So I have an army of 7 people read my blog. I want to see if I can get up to 700 or 7,000. We start kicking this thing out. Anyway, that's it for me.
For you to, the best day to start is now. Okay, so first and foremost, we have some upcoming events. This is for next week. Next week, Wednesday, we will have a guest speaker from the SEC. Wednesday, February 21. So normal meeting times at 7:45 p.m. We'll have some pizza there, have y'all entertained, go on and ask me some questions. I know from Adrian's contact as well, one of our MDs, they're coming in and visiting. Maybe they'll some internships, maybe some future, but for the most part, make those connections now. And then the day after, I know pretty packed schedule next week. We will have the alumni panel fixed income on Thursday, February 22nd at 6 p.m. to 8 p.m. in the Richard Liu building, coming in right through it's on the right side, coming in from, like if you're coming through the JPL. If y'all want to sign RSVP for the SEC next meeting, we just want to get a good count as to, how many boxes of pizza to buy for you all. Thumbs up, scan. Y'all good? Awesome. And then this is for the alumni panel. I know I had it out last week, but if y'all didn't get a chance to sign that in, go ahead and sign in. We will have alumni, Jason Benjamin and Carl. You know, they've been here, they graduated here at UTSA, asking questions. Hey, how did you, how was UTSA back then? How did you advance in your career knowing that employers knew you were from UTSA? What did you do to outcome that? How did you get ahead of the pack? And then we do have an opportunity more for the sophomore and juniors, Wells Fargo 2025 Corporate and Investment Banking Summer Analyst. The deadline to submit your application is March 3rd. And they want people with an expected graduation date of December 25 and June 26. So if y'all want to get that QR code signed, it brings you straight to their application. And with just some thumbs up, I'll move on ahead, and that way we can, come down here, talk to us, hang out, as well as, if y'all have any other plans. Here's our week. I know we had BP cancel. It would have happened this Friday. Sadly, they canceled. But we will have the SEC come over 21st and fixed income panel on the 22nd. Market watch updates. Awesome. If y'all see yourselves here on the top 11, congrats. Give yourself a high five. You can still join. Never too late to join. Scan the QR code if you haven't joined yet. Password is invest, all lowercase. And we will announce the winners in our last meeting. Last day to, put in your trades, April 24th. We'll shut it down. We'll get the first top 3, and we'll have some prize money out for y'all. Is anyone here on the top 10? Awesome. And of course, we are selling t-shirts and polos. T-shirts, $20, polos, $25, 24 members. Come on down here. We'll be here for a couple minutes. If you want to buy a t-shirt, buy one for your friend. The back design looks pretty cool. And thank you. Thank you all for coming in February 14th. I know probably you have some plans right afterwards.